Welcome everyone to our virtual fireside chat. Before we start, I'll share the agenda and format of the discussion. So this will be a 45-minute session in which the focus of the discussion will be around investment management, the role of an investment manager in the current environment, and Iridium's AI-based securities engine Deep Insight. Towards the end, we will have a 15-minute Q&A segment wherein the audience can ask questions to the speakers. So you can either raise your hand and ask the question directly or type them in the Q&A or chat box during the session. We'll take them up during the Q&A. So now I'll hand it over to Harshit to introduce our wonderful speakers and lead the discussion. Over to you, Harshit.
Thanks, Ayush. Welcome all. I think today's webinar session. I think what we decided is to have one of our partner organizations, which is Iridium, and they've created something which is fairly phenomenal and literally a crystal ball in sense. Right, so it's going to be a 45 minutes of interesting sessions. But so I've got our friends and partners here. So John Norauki. John is the COO of Iridium. He has more than 30 years of experience as an asset manager, and he was earlier the former partner at Rocketon Investment Partners. He's got experience all across, but prior to Rocketon, he was the managing director and heading the investment management committee for Rogers Casey. He's a MS and MBA from NYU Stern, but has experience in investment management all throughout. So welcome, John. I also have Thomas Phillips. So Tom is again an author and a professor at NYU. He teaches quantitative portfolio and valuation theory there. But he also has more than 30 years of experience in asset management and was former risk management executive at BNP Paribas, Malbec Partners, OTA Asset Management, and several others, right? So great to have you, Tom, and really look forward for your insights. And finally, our third panelist here is Cynthia Steer. Cynthia, again, has 30 years of asset management experience, and she was earlier the former EVP of BNY Mellon. She was a MD of Russell Partners prior to this. She's the chief investment strategist at Iridium, and again has a fairly vast experience in asset management all throughout, and was an MBA at Wharton and AB Smith College prior to that. So welcome, Cynthia.
Thanks so much.
Thank you. So, just as we start the discussion, and and maybe from you, Cynthia, now that we have a very interesting kind of a topic, which is effectively creating a crystal ball of sorts to predict in some form or fashion the share prices and fund of funds for the fund of funds and investment management. But where did you get the idea? What was the primary premise for the basic business idea as you started on the venture?
Thank you so much for introducing us, and good evening to everybody. The idea for Iridium actually was quite simple. I sit on 5 investment committees with assets ranging from around 100 million to 55 billion. And one of the things that has been apparent during the last 5 to 10 years is the lack of exposure in high growth strategies. What are high growth stocks? They're actually stocks like the big technology stocks. And why is this lack of exposure? Because have it in their passive funds, or unfortunately, many of the high growth managers have crashed and burned. But we also wanted to think about environmental, social, and governance issues in today's world. And so out of those 2 ideas, a lack of exposure to high growth stocks and active managers, and the willingness and really we wanted to get ESG into stock selection and stock analysis. Very simple ideas. We now have Iridian.
Got it. Got it. But just to kind of stress upon that a little further, right? So primarily the two reasons that you said was technology stocks and high growth potential areas, as well as the ESG or the environmental factors kind of not being addressed properly. So how does the Iridian tool kind of help address some of these areas and help investment managers take better decisions than what they were doing? Because it's been a fact that technology stocks and some of these areas have been doing phenomenally well for quite some time.
Yeah, that's actually a very interesting comment you make. The technology stocks and growth stocks in general have done well for a long time, over a decade. That can't go on forever. It's being driven by profitability factors that are unusual. It's being driven by customer demand factors that are unusual. It's also being driven by index rules that will tend to make it mean revert over time. So we think it's an unusual, it's designed to be an unusual take on markets. We've got a very intriguing set of nonlinear transformations of fundamental firm data, which turn out to be very powerful. We've got unique and timely ESG data that turns out to be powerful. And we've got some unusual market data that turns out to be powerful. The trick here is to put all these data sources together in a way that allows us to extract what the central drivers of a stock's return are, and then to use those insights to drive a portfolio.
Harshad, I'd also like to add some comments on the ESG. I think what's very different about our approach, Cynthia mentioned it, is integrating ESG, the environmental, social, and governance factors, early in the investment process. Why this is different, I mean, if you look at most major investment organizations, they're very clear about, hey, listen, we're doing ESG investing. But when you scratch below the surface, what's happening is either managers are checking off a box saying, hey, listen, we've considered these factors somehow in the process. It's very ambiguous where they're addressing the factors. Some organizations even will just have an ESG research group share the research with their entire organization, and that mere fact, checks a box in terms of including ESG principles in investing. We don't believe that's the right way to handle it. We actually integrate the ESG factors early in the investment process as a source of alpha, and clearly in our work thus far, the results have been very compelling, and we think we'll continue that way.
Yeah, phenomenal. Sorry, go ahead.
Just one note to John's comment is that ESG is a source of unique alpha. And that is unlike any of the alpha we've seen so far in many of the stock returns.
Got it. And what's phenomenally interesting in your case is you're beating the market, right? You're beating the market consistently for the past 3 years. In terms of various different indexes and by more than 6 to 8%. So just highlight that a little more, but also a follow-on question. What does this mean for an investment manager therefore, right? So essentially 2 parts to the question, right? First, how clearly by incorporating this, you're beating the market a fair bit, and it'll be nice if you can quantify it. But what does this mean for an investment manager as a overall, right? How do you see their role and their job kind of moving on going forward?
Sure. Let me just cover a few things, Tom, if you don't mind, in terms of the metrics and what we're seeing. I think the first important note is that all of the predictive returns with Iridian are benchmark relative. So we are highly focused on outpacing the market and beating benchmarks. we're seeing consistent alpha in what we call our walk ahead work, over the past 3 years, roughly 10%, which is pretty incredible. A tracking error of about 3% and very high information ratio, approaching 3. So these are, very, very, promising numbers, and certainly we would expect them to continue as we continue to teach the models and neural networks. But in terms of changing the roles of investment managers, artificial intelligence as a tool, enables going through a vast amount of data a lot more quickly. We like to think of it as having 4 or 5 floors of fundamental stock analysts working 24/7, constantly at peak efficiency, no bias. And that's what advanced AI techniques, such as deep learning that we are working with here, enable. Tom, would you like to elaborate more on that?
Sure. There's a bunch of things going on in the market which change from day to day, from week to week, to month and month to month. And what we've got to do is get ourselves, or get our model, a set of information, an information subset that is economically relevant. And then it's for the model to tease out what might be relevant to the pricing of a stock at any one time. Interestingly, we don't think about the stock market in isolation as a whole. So if you ask me, what do you think the expected return of the market is? What does Deep Insight say about the expected return of the market? We'd say, we don't know. We don't have a view on that. The way we model everything is relative to the market as a whole. And we do that in a unique way. Now, there are trying times, and we have gone through one just now, the COVID-19 crisis. We came through with flying colors, but I fully expect that in some other crisis, it might underperform. We built our information subset, though, in a way that we believe will allow us to continue to perform well over the long term, while being comfortable with the notion of all asset management processes stumble at some times, especially during market dislocations.
Harshad, I'd like to add one comment. In the end of your question, you were talking, I sensed you were asking, hey, listen, how is technology, or how could technology change the role of investment managers in the short and long term? And I think there's some really interesting things happening in the industry that we are plugging into with Iridian, but that are, you'll be seeing, have seen for the past few years, and we'll see going forward. In a nutshell, technology and data are table stakes for the investment management industry in many ways. If we look at where the spend for investment managers has been, that's the first good evidence. Over the last decade, a key trend has been the melding or combination of operations and technology. They used to be distinct functions within an organization, and now they're working more in concert. Yep. The spend for that group outpaces all others, with the exception of compliance, which is always, of course, a good thing. But your compound average growth rate of that spend for investment managers has been roughly 9% for the last decade, and there's no signs of that slowing down. A lot of that money has been spent on the integration of advanced technologies, as well as management of data. Not buying outside data, but more money is spent on managing internal data and generating alpha from that data. So very good indicators of where the spend is going. And all of this has to do with providing operating leverage and having to work at more efficient speeds to generate alpha. So that spend is, I think, a very important trend. Another important trend, you've got a massive amount of assets flowing now and into the future into the hands of individuals that work with registered investment advisors and even larger firms. Technology is playing a huge role in that trend as well. For example, investment managers are investing a substantial amount of capital in using AI and other techniques in the onboarding of investors. So it's more efficient, it's more value added. There's a lot more interaction between the investment manager and the investor, and they get a lot more value, but you don't have to use as much human capital. So that technology is helping with the trend of assets moving into the hands of individuals. And the final key trend is how are investment managers, generally speaking, adding value? And we like to consider it here outcome-oriented investing. And by that, I mean, you're helping investors focus on retirement. They may want more income. They may have a specific target, buying a house and want to have a certain return for a certain amount of time. Artificial intelligence especially provides unique tools to investment managers, be it in stock selection here or portfolio construction and many others, to help meet these investment outcome goals. So, yet another key application. So generally speaking, in the short and long term, we expect technology to continue to transform the landscape, not only of investment managers, but of that interaction between investors and investment managers.
That's very,
as John said, the stakes are getting higher and higher for asset managers because investors are facing an increasingly complex environment and they really want to have trusted partners. So this spend on technology is really part of still keeping the client happy and under their management.
Got it. So that's fairly interesting. So, as we see the new avatar or the new phase of people kind of coming in, which is technology enabled, and the investment managers are therefore able to take better decisions. And I'm hoping that you'll bring it to the new normal, right? And as we move towards that, are you guys planning for an ETF of your own? And what's the next step if you've created such a amazing model which is providing you a consistent alpha over the past few years, taking all the factors into account? So, given the fact that you've done the great, hard work, you've hit the jackpot, what's kind of the next step from here as you go along?
Yes, absolutely. Harshit, there are many different applications of Iridium for investment managers and investors themselves, and ETFs is clearly an important one of them. I mean, PricewaterhouseCoopers looks at 2020 as kind of a pivot point for ETFs and being incredibly important, not just for individual investors like
Hello? I think, did I lose John?
I think we've just frozen. It's just frozen. But let me answer that question.
For Tom? Sorry, for the index version of the strategy?
Sorry, John. We lost you in the middle for 15 seconds. So if you can, just...
Apologies. Apologies for that. So where we are far down the road in terms of identifying a calculation agent for the index version of the investment strategy. We're also in discussions with an ETF partner and determining if we could potentially be added as a sub-advisor and leverage their marketing muscle to get out. So a very important part of our strategy going forward, and we're making advances down that road.
Awesome. So, coming back to the brain of the entire piece, right? And maybe, Tom, if you can help me just decipher, how do you emulate the market, right? What are the various different factors you've taken into account? What are the factors you've eliminated including the interpersonal or behavioral finance portion of it and others? So could you put some science in terms of how do you do it and help us understand?
As I said, we don't focus on the market as a whole because that's exogenous to our objectives. What we want to do is outperform the market, and stocks are noisy. So if you subtract off the return of the market from the return of each stock, you get an excess return. And it's the excess return which is specific to each stock that we really want to focus on. If the market's up 20%, we'd be like to be up 30%, so an excess return of 10%. If the market's down 20%, we'd like to be down only 10%. Again, an excess return of 10%. So it's differences, return differentials that drive our thinking. And we use balance sheet information, income statement information, statement of cash flows information on the fundamentals side. On the ESG side, we use a variety of indicators of the quality of governance, their pollution levels, their friendliness to various groups in their HR policies, etc. On the market side, we get not only market-related data, but options-related data, which gives a different perspective on the market. And then we combine these things intelligently and rely on the AI engine to determine what's driving the return of the stock at any one time relative to the return of the market.
Got it. Good. So that is helpful. But help us define that further. And maybe is this application more applicable only in the efficient market scenarios like the US, where you have both the information as well as you believe the various different components of ESG and others are more easily accessible? Or do you think other emerging markets also it will be equally applicable as well?
I'd actually break it up into two parts. First, why do you focus on the US? And the answer is in large part because data is outstanding in the US, and largely because of historical accidents. The Center for Research and Securities Prices, the Coles Commission at Yale University, which has gathered fundamental data for a long time, the availability of databases going long back in time. So there's a real information advantage in terms of its breadth in the US. Also, financial reporting standards in the US are strict. In the US, you've got to report, firms have to report every quarter. In most of Europe, it's every 6 months. In some cases, it's only every year. So the quality of financial information varies across the globe, but that'll also have an impact on market efficiency. Likewise, the central ESG factors in different regions will be different, but also the availability of these factors will be different. Market information, we believe we'll be able to get in almost any region. But the precise factors that you get will be different in region A versus region B. Accounting standards will be different in region A versus region B. And these will all lead very likely to different models and different weightings of the different components in each region. That said, we believe it can be used worldwide, though the US is probably the best place to start just because of the ready availability of data.
Got it. I mean, that's fairly interesting. The fact that fundamental aspects do weigh so much in the relative stock performance, as well as all the fundamental aspects as ESG, as well as the sentiment which is reflected in the option prices as well. But what would you say that the current set of investment managers are putting their more weightage on where you are not, right? So clearly, how is the philosophy? And you touched upon it to a certain extent, saying that ESG you're stressing on more as compared to a traditional investment manager. But is that the only reason that's giving you a better performance? What is the current investment manager making a mistake to not on average being able to beat the market?
So people do a number of things. So of course, not everyone is an ESG believer. So many people just say, look, don't touch this. We'll just do it without ESG. Some people are very detailed balance sheet investors. Some people are very detailed income statement investors. Some people work largely of earnings expectations. It's important to strike a balance between what you look at and what you then input into a model for it to then pick up what the market is pricing at any one time. Now, it may well be that at some points in time, the ESG factors will dominate everything else in terms of the market's perception of a stock's value. And other times, it'll be the balance sheet. And yet other times, it'll be the income statement. Yet other times, it'll be what's going on in the market as a whole. Let's call it market variables or sentiment. So you've got to be able to modulate your view between these things. And what traditional managers do is tend to focus on one area and settle down in there. So their worldview doesn't adapt to a changing world. Our worldview changes, but we let the machine work for us and adapt our worldview sensibly as time passes by.
And I think, Tom, go ahead, I didn't mean to interrupt you, Tom.
We want to be fundamentally grounded in our thinking about the underlying factors. We do want the market to have the ability to move our perspective around as time evolves.
Tom, I hope you don't mind. I just want to build on one of the points you're talking about, because I think it also addresses data availability. We talked about the focus on the U.S. and availability of data. What's very interesting about our model is that in fact we do have availability of fundamental and ESG data for example in India, option and macroeconomic data as well. So this can be trained by Eurodent. But importantly, as Tom is alluding to now, the factors may be different, focuses may be different because it is a different market and there are different factors going on. But let's make it very clear, the data are available out there. We've got a robust model that can, and robust engine is a much better way of looking at this, to look at these data, connect the dots in a different way, using different factors, as Tom is alluding to, and add value in an efficient market, in inefficient markets such as India.
Got it. And fairly interesting. So what you're basically saying is the AI-based models have therefore been able to do it, and it can be applied to more relatively inefficient markets or immature markets like India, which is fairly interesting. One other question is, what do you think is the adoption of AI within the investment management field, and how do you think that evolving over a period of time, and would that be able to predict some of the unreliable or unexpected events like the current?
AI is going to be accepted and initiated in every asset manager. It's really a question of whether it's going to be a tool or whether it's actually going to be integrated into a strategy. It is a necessity, a competitive necessity, and you're going to see integration either early in the investment process or later in the investment process. It really is, it's not an if, it's just a when, how much, and whether it changes the fundamental investment process. For a lot of active managers, they're fairly cautious about changing their investment process unless they have more data. But I would think if you look out 5 years from now, you're going to find this creep to the beginning of the investment process where we're using the AI data right now. That is what makes us so different. We're not value, we're not growth, we're indifferent, all right, to the data, and we're letting the factors speak.
Harsha, you in terms of the competitive set and how, I'd rephrase your question if it's okay, to be how do you differentiate, and what's going to differentiate managers in the coming years? Mm-hmm. It's which dots are important in selecting securities and how do you connect them? That's going to differentiate alpha for the foreseeable future. And being able to be nimble, and especially if you're moving into different markets, as we certainly plan to in terms of looking at different markets, different data, but identifying the right dots, connecting them the right way, and recognizing that that is not a static proposition. That's something that you've got to continually do. So, that's where the nimbleness comes in, actually having to do that. So we like to think we have an advantage as, certainly as a startup organization, but smaller organization, because we can connect those dots a lot faster.
Got it. I know we are, kind of coming towards the end of the 30 minutes, and before I open it for the audience for questions, one, kind of last question. When you went around, developing such a product, why did you choose Hashdin, or how did you go about doing it, and why did you choose Hashdin?
Well, naturally, there's the baseline of very strong technical capability, smart people, etc. But I think what was so unique about working with Hashdin, we do have a very unique approach to artificial intelligence. I think the intellectual curiosity of the entire team and saying, well, that's kind of interesting. How do we get this done? How do we use advanced technologies to identify these dots, connect these dots, as I was saying before? From day one, from design to architecture and implementation, that drive, that focus on finding a solution has really differentiated Hashdin, and we sensed that early in the process as we were speaking with other developers. It wasn't even close, if you want, in my humble opinion, in our discussions, because immediately you embraced Hashdin embraced what we were trying to do. And that is carried through every morning, evening that we are working with the teams to not only develop Irident, but make it better each day.
Got it.
I would also add that, what defines investment management and defines success is teamwork. And Hashdin is not an extension of staff. We deal as a team, and that to me has been the overall hallmark of our relationship with you over the last couple of years.
Absolutely, Cynthia. It's a great point. Great point.
Good. So, just moving on to some of the question and answers, and I've got some of the questions here. I think the first one is from Nishant Agarwal, and just taking the question. If the dream were to come true, that is AI model and investments consistently outperforming the market, and everybody probably use it as some kind of investment market. In this scenario, and markets become more efficient.
Yeah.
Do you think the decision making will be significantly more scientific or human? I think you answered that, but I think the question is also from Nishant is how much scientific or how much automated would those decisions be?
Tom, you want to take that first?
Yeah, I'll take that. As you get more and more technology looking at things, and this has been going on for a while, inefficiencies do get arbitraged away, but then new inefficiencies appear. So you've got to be nimble enough to move across inefficiencies as they evolve over time. In general, I think it's fair to say that markets become more efficient over time globally. But if you have a static investment process, you've got a problem. The other surprising, the intriguing question that you ask is the world going to be purely scientific, or will there be individual deep thinkers? I think you'll see a bifurcation. There's a lot of stuff that can be done very well by machines, but there's also some stuff that deep thinkers do. They somehow integrate the world around them in ways that aren't always obvious at all. And I think those people never go away. They remain, and their skill set evolves and their worldview evolves over time. Their ability to integrate the world in strange and unusual ways will always be of value. But for the rest of us, machines will continually provide us with additions to our skill set that are incredibly powerful.
Tom, I really agree with that sentiment. I want to add one element. It's a chess match going on out there. So Iridium, what we're doing is for investors. We're adding value for investors. We're on their side, right? You have another whole side out there of folks with proprietary trading books. They've got their machines, and in a lot of ways, it's a race. Like who can build the better machines. But at the core of building those machines, quote unquote, it's the design element, it's the human element, the creativity that changes things and gives you that edge. As we mentioned and continue to mention, what are the right dots? How do we train, a neural network to choose the right dots and connect the right dots? That is largely, driven by humans, and that's not going away. That chess match has been going on for decades, and it's going to continue to go on for decades.
Got it. And which is actually one of the questions that one of the guys has asked, which is Kaushik Nepali. So Kaushik's question is essentially exactly fairly similar. That while the factors that we understand make sense, but what becomes difficult when we are making a model is just the permutation combination of a huge number of factors which have to come into the right set of being. Right. So how do you bring these optimizations in a deep learning scenario and developing a model?
But that's actually one of the more interesting things that goes on under the hood. We've got to be able to filter out a huge amount of irrelevant information, focus on the few things that really do matter at a point in time. And once you do that, you can get the optimization in closed form for many cases of practical interest. When you're doing it in practice for a client who has constraints, you will need to use an optimizer, but those are widely available. But you can come surprisingly close using closed form optimization solutions. The one thing that's very important is the noise filtering. You've got to get rid of noise. You've got to get rid of extraneous factors. So there's a huge amount of robust statistics that's built into the process that allows us to focus on the data and its central aspects and not get pulled away by noise.
So in a nutshell, Harshit, very carefully because the devil is in the details.
Yeah. Yeah.
Which kind of is a different question, right? So a question which has come from Kshitij Bhatnagar as well as my friend Neeraj Keli, which is essentially how in the world could you have predicted that the stocks will just go down so badly in the COVID scenario and then come back skyrocketing back up, right? So both the questions, how can an AI-based model ever be able to predict?
Yeah.
And second part of the question is, how did your model perform during such time?
The answer to the first one is don't ever try and predict the market. Over the long run, it's actually surprisingly easy to lay out what the expected return of the market's got to be. You can work it out from economic growth, from free cash flow yields, etc. In the short term, anything can happen, and everything does happen. There's no way in which we could have forecasted the COVID-19 crisis. There was no way in which we could have forecasted the depth to which markets would fall. More importantly, we could not have forecasted that they'd recover so quickly, which is why we focus not on markets, but on the difference between the return of each stock and that of the market. It's only active returns or excess returns that we want to focus on. And those are very strongly correlated with fundamental variables, ESG variables, and market structure variables. But if you said to me, can you focus the next financial crisis or the next COVID crisis? I'd say absolutely not. And we've got no plans to do that either. We don't even want to get started trying that.
Okay. So, again, question, how could you ever expect a person to believe an AI-based model which truly lacks explainability to a certain extent, right? It's very difficult to put the, it's okay to put the money because I trust an investment manager, but developing trust on an AI-based model, that requires a leap of faith. It's really difficult to truly say and trust it, and how would you respond to that?
Sure, Tom, I'll take that, and if you want to add, please do.
Sure. Go ahead.
The proof is in the results. So Harshit, another prominent trend, and it's mostly among institutional investors, is a focus on holdings. And what we see with institutional investors certainly will eventually make it down to retail investors. More than ever, institutional investors want to know their holdings. They want control over them. They want to understand what's happening in their portfolios. This is how they answer the question, even with fundamental, pre-existing investment managers who are picking the stocks on their own. Their proof in how their manager is performing is in looking at the holdings, and we hold ourselves to that same standard. We've gone through how we have built the Iridium and how we refine it and how we continually refine it, but the proof is in looking at the holdings. So among some of the tools that we've integrated with Iridium are industry leading portfolio analytics at a holdings level about the investment strategy. So if someone's curious about, well, I want to know more about this strategy, there are plentiful analytics, plentiful portfolio-oriented analytics that give a sense for how the strategy is working. And more importantly, these advanced analytics pull apart your holdings over time and say, well, listen, how is the investment manager adding value? And when we look at these important analytics that are provided by FactSet, one of the prominent areas, or the most prominent area, is stock selection. And that is exactly where we would want this strategy to be and how we view ourselves. So the proof is in looking at the holdings, what is happening, and applying advanced analytics like we have with FactSet to get a sense for how this strategy works. Tom, do you want to add anything?
I think we've lost Tom, but I also want to
lost Tom. Cynthia, do you want to add something?
Yes. Look, in the end, I sit on a number of committees and I sit across from managers every day. It's not only the analytics, it's how transparent, but it's also the seasoning of the team. This is where the combination of the deep experience of HashIn and our team's deep experience on a variety of fronts will communicate to investors. We know how you think, we know what you want and expect, and we are delivering this. It's about prudence. It's not about being perfect every time. All right?
Yeah.
We're not going to be right every time.
Sorry, go ahead.
No, I promise that one thing I just want to emphasize, FactSet is a strategic partner with Iridium, and that's purposeful. I mentioned before how data and technology are table stakes for the industry. It's certainly for us. And the analytics and looking at the portfolios and making sure we were with the industry leader in doing that was very important to us, and that's why we partnered with them. So FactSet's been an important partner as well. Sorry, Harshit.
Right. Yeah. So, kind of a next question. So, how do you predict the date? And this is a question from Ravi Tadela. And his question is largely, how does the daily news get incorporated in the stock market? So it's reflected in the stock market, but how does a AI-based tool reflect this information? I'm sure the ESG data does not change. I believe the option data would change on a day-to-day basis, but how would you respond to that part of the question in terms of daily?
I'll respectfully try. The ESG data changes daily. It's dynamic and it's real time, and we integrate that. So I'll let Tom answer, but again, as you can tell, we're very passionate about ESG investing, but that data changes daily. It's dynamic, and we treat it as such in the model. Tom, go ahead.
Yeah. You want to be careful about overreaction, just as you want to be aware of what's going on in the news, which will be reflected in prices. You want to be careful of overreaction to short-term movements in prices. This is a low turnover, long-term strategy. And that'll be reflected in the fundamentals of the firm, the market characteristics of the firm, and the ESG characteristics of the firm. We're not trying to make money by trading in and out of a stock. We want to have a very low level of turnover and find ourselves holding fundamentally great companies for long periods of time. There are high-frequency hedge funds, by the way, that do textual analysis. Some have done well, some haven't. It's a mixed bag. But it's clearly very easy to overreact and to start paying out transaction costs, which then erode your return and your competitive edge.
Right.
Harshit, I want to go back to the ESG data issue. We have that so integrated so early in the process, and it is daily. This is very unlike any other manager we know. And the reason is we passionately believe that we're not capturing in the broader investment management market all of the ESG data or the impact of it. Because studies so far have largely said it's not important in terms of unique alpha. We believe it is.
Got it. I know we are running towards the end of our session, but one last and most important question. So during the exercise over the few years that you've had, what are the learnings and what are the failures that you had, right? I'm sure you went wrong in terms of your hypothesis at certain points or other. What have been the learnings and what have been your takeaways from that?
Tom, why don't you take that? But
yeah, go ahead. No, go ahead. There've been so many.
You know, and Tom and I are both, and Cynthia are all smiling. Harshit, what's been very unique about developing Irrident, yes, we had it started, on a fundamental basis. And what are the important factors? How do we put together how do we look at stocks on a relative basis? How do we integrate ESG? What's been very unique about Irrident and using deep learning techniques, I think what we've accomplished in the 18 months plus of development is that what takes a stock picker, just humans starting an investment strategy, doing their own analytics, picking stock and doing it over time, they make mistakes. They make mistakes in picking the wrong stocks. They misread, a particular factor. And what I think we've done, is Tom's laughing, is you make a lot of mistakes along the way. But I think in a year and a half, we've gone through like a decade of an investment manager picking stocks, making mistakes. And we like to think of it, well, we've done this, using machine learning and refining the model before we're actually taking on assets, whereas a lot of investment managers do this with other people's capital. So, there have been many. Tom, does anything else you want to highlight in that process?
Well, the factors that we thought would be very important in fundamental data that turned out to be much less important than I thought it would be. We found that FactSet, which is a very large organization, and sometimes needed its reports to be debugged. That was a huge surprise to us. We were essentially debugging some of their reports for them because we were stressing them in a way that they hadn't been stressed before. That was a big surprise.
Good partners, absolutely.
Yeah. So in any startup, there's always things that go wrong. There's always lessons you learn. You just have to keep rolling with the punches, correct them, and move forward. That's the only way to do it.
And you have to continually tune the model, Harshit. It's not a one and done and you set it and forget it. It's not only ongoing now, it will be in the future. That the art of this is in continually tuning the model, and that's our lifeblood.
Good. I think that is great information and fairly relative. And what's surprising for me as well as for all of us, I've had a lot of debate with you guys on the same factor. I'm still find it difficult to believe that fundamental factors are actually so important rather than the rumors, the daily news, and others. And it just does not stop amazing me. Throughout, because we've just been attuned so much to it, right? So thank you all. Thank you, John. Thank you, Tom. Thank you, Cynthia.
So thank you.
Thank you.
Thank you so much. All right.
Thanks, everybody.
All right. Bye-bye.
Okay, bye.